Hello, and welcome to the Industry One Team A Major Innovations Business Strategy Game presentation. My name is Jose Vasquez, and I am a business owner from Edinburgh, Texas.
My name is Michael Skabarczyk, and I'm a construction project manager based out of Corpus Christi, Texas.
My name is Araska Rodney, and I'm a technical manager for operations strategy for the world's largest wine company out of San Francisco Bay Area in California.
The following presentation outlines the onset of our dynamic strategy from years 11 through year 17. For year 11, we did not have a set strategy and did not stray from the industry standard projections and expectations. Early on, our goals were to acquire a benchmark after scanning and assessing the external marketplace and our competitive environment. Since we had not been able to scan our environment and our competition, Year 11 focused on industry standards such as standard quality, best value, limited number of models, and we started off with zero celebrity appeal and a brand reputation of 70. After year 11, we went ahead and decided to apply a strategic vision and a strategic move in order to go ahead and gain market share and gain revenue. Our strategic vision leading into year 12 was major innovation aims to offer high quality shoes to the global branded and private label markets and its respective segments while maintaining a dynamic, sustainable strategy that will increase shareholders' wealth and its contributions to all stakeholders. Moving into year 17, our main objective was to align our business model with our strategy in order to create a value proposition for our internal and external customers. In year 17, we focused on highest quality, price premium, a high number of models, increased enhancement of styling features. We also brought our celebrity appeal from 0 to 235 and our brand reputation from 70 to 100. And that, of course, led us to a market share leader standing for the whole segment in North America, as well as all the other segments.
I'll go on and talk about the net revenues. As you can see below, there was a gradual increase in total revenues from year 11 to 17. Our goal was to increase our market share in the industry by providing a higher number of models with a higher quality, which also meant we were striving for our products to have a higher SQ rating. In year 11, our sales were $553 million, and in year 17, we passed the $1 billion mark with $1.76 billion in sales. To increase sales, we were more focused on increasing our market share in the internet and wholesale segment versus the private label, since the private label demand was so much lower. As the game went on, we felt that if we could fulfill all of the forecasted demand in wholesale and internet segment, we would increase our market share. In year 11, we represented 11.9% of the wholesale segment, and at the end of year 17, we represented 19.8% of the wholesale segment. While our sales increased from year 11 to 17, our cost of pairs sold also increased. Our team had some of the highest costs in the industry, but as a team, we decided that if we paid our employees higher than the average pay in the industry, this would inevitably increase the compensation for our employees, would decrease our reject rate, and increase production, which led to an increase in overall sales. If we did this again, we might have reduced our overall cost and paid our employees less, but it also could have had a negative impact and affected the forecasted production. Now on to earnings per share. The earnings per share is a portion of our company's profit that is allocated to each outstanding share of common stock. As you can see in this chart, we gradually increased our earnings per share from year 11 to year 17, and we were much higher than the investors' expectations other than year 11. Year 11 was our first year in the game, and although our net sales were second highest in the industry, we sold $2.98 million in stock and had $0 on hand at the end of the year. An increase in stock offering allowed us to finance expansion at a cheaper cost of getting a loan, but it also lowered our earnings per share. Year 11 earnings per share could have been increased if we would have sold less shares of stock or went on and got a loan to cover the expense. Our earnings per share increased from $5.17 to $5.47 from year 13 to 14, and this minor increase is due to our purchase for construction of new space, and because we did not buy back or sell any stock. As you can see from years 15 to 17, we did have a high increase or a steeper increase in the earnings per share, and this was due to a buybacks of stock, which was 12.6 million in year 15, 70.84 million in year 16, and then $254.5 million in year 17. If we were to make any changes, we would have possibly purchased more stock earlier in the game to increase our earnings per share. Now on to stock price. As you can see, our stock prices increased gradually from year 11 to 17. From year 11 to 12, we had our largest increase in stock, which was at 192%, but only increased 3.7% from years 13 to 14. From years 14 to 15, it increased 24.8%. 15 to 16, it increased 33.8%. And years 16 to 17, it increased 25.2%. All of the stock prices from years 11 to 17 were higher than the investors' expectation. There was a much steeper increase in stock price between years 15 to 17, and this was caused by stock buybacks and also the increase in overall sales revenue from one year to the next. Another item that affected the increase in stock price is the distribution to shareholders as dividends between years 15 to 17. If we were to change anything, we would have tried to increase the stock price more between years 11 to 14 by either purchasing or selling more stock. Also, if we were to play more years in the game, we would continue to pay out more dividends to shareholders, which would increase our stock price. Now, Roscoe would go on into further detail.
Hello, once again, my name is Roscoe Rodney, and I will be reviewing a competitor analysis of the team we believe best matched up against us from a strategic standpoint, and also key moves we can make moving forward to put us in a more favorable position with investors, increase our profit, and increase our stock price. As you can see from the graphic from the North American market, from a competitor standpoint, Team E was our closest competitor in terms of SQ rating, model availability, sales, and market share. We were, however, superior in SQ rating, celebrity appeal, retail outlet availability, and overall market share when you combine both the internet and wholesale segment. However, Team E did beat us on price, which makes them a strong competitor when variables such as quality via the SQ rating are so close between the teams. They had an 8.5 SQ rating, whereas we had a 9. It is apparent that they, like us, were employing a broad differentiation strategy, which is supported by the fact that they had 500 models available and a high SQ rating and was pulling away from the rest of the market. This strategy works well for larger companies like ourselves and Team E being the top 2 largest companies in terms of revenue, as we can see on the graphic. And as we seek to bring in a broad range of shoppers from a competitive field, using a broad differentiation strategy was the best strategy for us to use. Moving on to financial analysis. The financial analysis of the 2 teams show that Team A, our team, pulled in more revenue and had a slightly higher gross margin. Here I have our total revenues and a vertical analysis of other metrics as a percentage of our total revenue. You can see that Team A was superior in managing costs in logistics and operations related activities, but vastly outspent Team E when it came to marketing and administrating expenses. In fact, our team vastly outspent the rest of the industry in terms of marketing and administration expenses for most of the simulation. This hurt us because it reduced our profit margin, which makes us look less favorable to investors. Our marketing costs were 27% as compared to our revenue, while Team E's marketing and administrative costs were 21% as compared to their revenue. Moving on to the next slide. A high-level balance sheet analysis shows superior performance for Team A with total assets and lower liabilities. Team E, however, had more cash on hand at the end of year 17 and less equity. This to me could be a fault in the game when it comes to calculating return on equity, because I believe this metric can be manipulated by simply buying more shares of your own stock. Reducing your ending equity will push up your stock price and also look more favorable to investors because of the way return on equity is calculated. The calculation for return on equity is net income divided by equity. So as you lower your equity, you increase your ROE. Not buying back more shares hurt our favorability when it came to this metric and in the eyes of investors. And I'll be talking a little bit more about this on the next few slides. Next slide. So moving forward, these are the three top strategic changes I believe that we could make to increase our favorability with investors and also the marketplace. First being reducing our ending equity to increase our return on equity, as I explained in the previous slide. This will help with having a higher score on the weight for this metric, which is a part of the investor expectation metric used to rank the teams. Second being reducing our spend on marketing. Even though we led the industry with sales, because we spent so much on marketing, we hurt our profit-making ability. We have to find a better way to manage this cost. Our competitors were able to do this, and we have to find a better way to compete with them as well. And lastly, continue to invest in our quality via our SQ rating. Continue to raise this metric will help with continuing to pull away from the rest of the marketplace as we follow our broad differentiation strategy. If we are able to increase our SQ rating while keeping our costs of our shoes the same, we would look more favorable in the marketplace. Next slide, please. And lessons learned. The major lessons that we learned is that we have to continue to differentiate, pulling away from the rest of the market and appealing to a broad base of customers. We did this by increasing our quality via our SQ rating, increasing our number of shoes available, and better marketing to individual stores by giving more support to each one of the retailers. We have to manage our investor expectations better by bolstering our stock price, by buying back more stock, and we have to monitor our costs more closely, specifically our administration costs and also our operating costs.
So in conclusion, I would say our strategy outcome allowed major innovations to create a sustainable revenue model that exceeded the expected earnings per share, returns on equity, and allowed major contributions to CSR, which in turn helped us dominate market share throughout all the markets in the wholesale segment. Adding and assisting to our success was the fact that we did not ignore competition and our external environment. And that is it for our presentation for the BSG game. Thank you very much. I enjoyed it. How about you guys?
Loved it
as well. Thank you.
Thank you.